live. All right, cool. All right, so we do these weekly wisdom webinars every Wednesday at 1 o'clock. And really, it's just an opportunity to come on and answer any legal, financial, tax questions that you may be having. And sometimes people submit questions ahead of time, and sometimes we get some questions submitted kind of on the fly. Good afternoon. Good afternoon to you too. All right. So if you do have a question, please put it in the Q&A. Otherwise, excuse me, we'll go ahead and get started. And here we go. Share my screen. Plug in as required. All right. And now, whoops. Hold on. Hit the wrong button. Oh, and I was start with positive focus. Positive focus was that I made some delicious barbecue the other day. Brisket. It's like one of my passions is smoking meat and doing barbecue and stuff. Like I really enjoy it. All right, now share this. All right, now we should be screen. Okay, cool. All right, and keep in mind this is just general information. First question, with the legacy trust, if both spouses pass, do the kids get a tax ID and file separate tax returns? Is it complicated from a tax perspective? And from a estate planning perspective, we see different types of trusts. So we have our basic revocable living trusts. These are just basically outright distributions. Then we have what we call our legacy trust. This builds in the opportunity of a lifetime of asset protection for your beneficiaries. So your one trust could split into separate shares, one share for each child. And then each child could then invest their trust however they want. And they can manage it. They can decide to keep it in the trust. They can take it out of the trust. It's really up to you or up to them. So the question is, with the legacy trust, if both spouses pass, do the kids need to get a separate tax ID number? The answer is yes. So while you're alive and well, you have your own Social Security number, okay? And this is what you would open up accounts and those types of things. And then like if you're to open up a LLC, you have to get a employee identification number, or it's called it's an EIN. But you have to get these with like LLCs or corporations or trusts, some trusts. So to answer your question, yes, the kids would have to get a separate tax ID number for the trust so that they could open up an account in the name of the trust. With that though, you wouldn't pay any trust tax rates. So I'm looking at my handy key data 2022. So if you're to make over $13,450 and the trust pays the tax, you'd be at the 37% tax rate. But that's not what we do. What we do is, okay, let's say the kid inherits this trust. Okay. The income would come directly out to them and they would pay income tax at their personal income tax rates. So it would be through a K-1. So it's not that complicated. And again, if at the end of the day, they want to just take all the money out and not deal with it, they don't have to deal with it. So long story short, yes, the kids would have to get a separate tax ID number. No, they wouldn't pay any trust tax rates. They'd pay it at their own personal tax rates. So really from a tax perspective, it's not that bad of a deal. So okay, so hopefully that was helpful. All right, here's another question that came in. I'll get to those. Can a pension go into a castle trust or any type of trust? And again, a castle trust, this is an asset protection trust. The benefit of this is that it starts that 5-year race for Medicaid purposes and also protects against long-term care or lawsuits as well. But a pension is like Social Security, okay? These are just income streams. There's no planning, not even any type of estate planning that we can do with these. Okay, once you have that pension and it's locked in, there's nothing we can do. Now, if you are working, you may be offered a lump sum buyout. And now that pension could be turned into, say, an IRA. And then if you pay the tax, then it could go into the trust. But if you keep it as a straight pension, then it's just a straight income stream. It's not like an asset that generates income. Same with Social Security. Like, those are just plain income streams. There's nothing you can do. There's no planning on, there's no planning. There's not even estate planning. Like when we're talking about funding a trust, changing beneficiaries and things like that, you can't do it with Social Security. It's spouse, and basically that's it. It's similar with a pension. There's different types of pensions. You could take a straight life, you could take a joint life with a spouse, things like that. But from an estate planning perspective, we can't put it in a trust. We can't change beneficiaries or anything like that. And a lot of our clients do the lump sum buyout. And that's one of the reasons is, okay, if we do take that pension away from the employer, now we have control and we can do different things with it. Versus if we leave it at the employer, you're stuck with this income that comes in that's taxed for the rest of your life. So a lot of people do the lump sum buyout, but if it's a straight pension, or the person's already retired and it's straight pension, then there's nothing we can do, even from an estate planning perspective. We don't change beneficiaries or anything like that. So, all right. So that was all the submitted questions. Now a couple of questions coming in right now. So I-bonds, update on I-bonds. I still think these are a great deal from November through April. Right now, they're giving you, and I just had to double check, 6.8% rate of return, guaranteed for the next 6 months. So that's not bad. Keep in mind, we want to hold these for at least a year. Really, they're on a 5-year chassis. If you take it out after a year, but before the 5 years, you have to pay back, or it's 3 month, basically a 3-month penalty. You don't get the crediting rate for 3 months, but still for money that you have sitting in cash. Oh, the other limitation, you can only put in $10,000 per person. Or I was just meeting with the client. He did the 30,000 because he did himself, he did his wife, and then also he did his trust. So trusts. So with that, so 10,000 here, 10,000 here, 10,000 here. So he was able to stock away $30,000 into the I-bonds, which it was at, I think, 9.2%, but still right now, for the next 6 months, it's going to be at 6.89%. Now, historically, I-bonds have not performed well, like 1-2% rate of return, because they're tied to inflation. So with inflation being so high right now, still, where we're looking at record Social Security jumps, I-bonds still make sense. Just I would be mindful and look at them every year, because I don't think inflation will keep up like this. But for the next year or so, if you have some additional cash, this is a great option. Another option is a tool. It's an investment. It's called Legacy Excel. And what it can do is offer like a fixed rate of 3% for a year. Or you could have it invested in the market where it's principal protected. But there's a nice thing about this is there's no limit. So if you're sitting on like $100,000, you can't put all of that into I-bond, and putting it into a CD probably doesn't make sense. Okay, so that's I-bonds. Let me see what else we have. All right. All right, so here's the question. So one spouse passes. Is there probate? Do you need to put notice in the paper for creditors, submit bills? What is the time frame? Okay, so really this is getting to basic estate administration. So when someone passes away, whether it's a spouse or anyone else, there's 4 ways assets transfer. One is through joint ownership. So a lot of times with a married couple, they're going to own things jointly, like the home, the checking, the savings account. Second would be through beneficiary designations. So this would be like what we have on a IRA, a 401k, a life insurance policy. And typically the spouse is listed as the beneficiary. Third would be through a trust. And there's different types of trusts, but if an asset doesn't pass through joint ownership, beneficiary designation, trust, then it ends up going into probate. And that's where, yeah, we have a core process that takes at minimum 5 months. You have to post notice to creditors. You have to do an inventory. You have to do an accounting. So that's where it takes at least 5 months to sometimes over a year when things end up going into probate. But when one spouse passes, typically most things are handled either through joint ownership, beneficiary designation, trust, so you don't have to jump through all those hoops. So no, you don't have to post notice to creditors. There's no specific time frame, and you don't have to go through probate. It's typically when the surviving spouse passes away, that's when things get a little messier. But by having a well-drafted estate plan with typically a trust that's funded properly, everything avoids probate and you don't have to jump through all those hoops. So hopefully that was helpful. All right. All right. Next one. I was just talking to someone about this. So the question is the pros and cons of reverse mortgage. So there used to be a lot of people that would have reverse mortgages because there was a lot of salesmen selling these. Then they changed the rules probably like 10 years ago. And basically what a reverse mortgage is, okay, let's say you have your home, but now we're going to start stripping the equity and that's going to be turned into income. And then when you pass away, instead of the house going to the kids, then the house typically goes back to the mortgage company, okay, if depending on the value. So the advantage of this is, or why do people do this, is this can offer income, okay? So if you're short on cash, it can offer income upon, you can generate income. Typically, we would first look at like your other assets before we do this. So this would be like, all right, mom and dad are kind of running out of money, something like that. The disadvantage is you're locked into this, and at the end of the day, a lot of times the house is going to go to the mortgage company instead of going to the kids. Another negative is they were really oversold back in the day, but they've changed around the rules. What are the pros and cons of using reverse mortgage to pay for in-home care or the cost of assisted living? In-home care, I could see the reverse mortgage being used, but if someone's in assisted living, typically that's where we'd look at selling the house. But I don't recommend reverse mortgages very often. Typically we're looking at other funds. Back to question 1. If the child of the deceased trustee takes a partial distribution, then do they need to file a separate tax return for the new EN at the end of the tax return? Yeah, you're gonna have to file a tax return and then a K1. So this was getting back to question 1. Yeah, you have 2 tax returns. You have one for you individually, and then you have one for the trust. So again, it is a little more complicated, but so why would someone do it if it's adding complexity? Is because now you're giving the opportunity to protect the kids from divorces, creditors, and the money stays in the bloodline, stays in the family. So that's the advantage of doing the trust. The disadvantage is, okay, yeah, we have to do a separate tax return. So kind of weighing the pros and cons. All right, cool. And let's see, any other questions? Going once, going twice. And just a heads up, if you want some more information on this stuff, we are back to doing our educational workshops. Usually we have about 1 or 2 a month. These are in person near one of our locations. So tonight we have a workshop that's going to talk about legal, financial, and tax planning in 3 easy steps. We're going to be doing that at Cleary in Howell. And then I think next month we might have something lined up in Livonia at Schoolcraft College. So if you're in the Livonia or Livingston County area, we have some educational workshops. Just give our office a call and we can get you signed up if you do want to attend. So With that, thank you, everyone.